Hello everyone. Today's topic for discussion is basic accounting concepts, in which I'm going to cover the concept called as accounting equation. The accounting equation is basically assets is equal to liabilities plus capital. We are all aware that it represents the fundamental accounting equation and it acts as a basis for double entry bookkeeping. It is a core concept of accounting and it also tells us how a company's resources are financed and allocated. So I'm going to discuss each and every component or the element in the equation. The first and foremost component in an accounting equation is the assets. So the assets are basically that's what a business uses to generate a revenue and run its operations. These are basically owned by the company and it is being controlled by the company, and that would fetch them uh, a benefit or an income in a near future. So the assets are basically classified as tangible assets such as cash, buildings, equipment, inventory. And intangible assets are basically patents, trademarks, goodwill, etc. And we are going to see the example. What are the benefits of having assets? How does company utilizes assets? How does it generate income from the asset? Say for example, a property or a building. This is a fixed asset or a tangible asset. A company might own a commercial property for its own operation or as a rental property. So what is the benefit out of it? It can generate a rental income from the leased properties, and that would generate a regular revenue stream. And if used for the company's operation, it provides a location for the business activities, and it also add a potential appreciation in a property value in a near future. Again, if you take an example of vehicle is also a asset. So how does vehicle benefits the company? The businesses uses the vehicles for transportation of goods and not only for providing services but also used by the employees. And the benefit aspect out of it is the efficient transportation ensures that there is a cost savings, increased productivity, timely delivery of products and services, and overall it enhances customer satisfaction. And if you see the intangible assets uses, the companies protect and leverage the intellectual property to maintain a competitive advantage. So the intellectual properties such as patent, trademark, that can provide a legal right to the businesses, and that ensures the market differentiation from others, and that definitely and potentially increase the business market share and profits. So these are all the examples and how the assets are being utilized by the company and what are the benefits of owning and controlling the assets. So ultimately, no doubt that it is going to generate a income in a near future, and properly managing and utilizing these assets is a critical aspect of accounting and the financial decision for the businesses. And no doubt again, they provide the means to generate revenue and reduces cost and enhances profitability. Next component in the accounting equation is liabilities. So what is the meaning of liability? See, the liability is are the financial obligation, the debt that a company owes to external parties. So it is a loan raised by the company, the loan borrowed by the company from other external parties, such as loans, or it may be an accounts payable, or they may borrow in the form of bonds, etc. It also represents the claim on the company's assets by external entities. Liabilities indicate how a company has financed its operations and acquisitions. So in other words, in simple words, let me explain. Why it is called as external parties? Who are all called as external entities? The external entities are nothing but means that liabilities in a company's financial structures are the obligations or the claims that the external parties, they are creditors, lenders, banks and other financial institutions, they are comprising of these external entities. And in very simple term, when a company has liabilities, it owes something to external entities. That is, it has borrowed money from external parties. The company has borrowed money from the external parties and it is liable to repay those money to the external entities. That is said to be the meaning of liability. And these claims, the liability may be in the form of loan, short-term loan, long-term loan, or it may be the form of accounts payable, creditors, bonds, other obligations that the company must settle in the near future. So this concept is a fundamental in understanding how the company assets are financed and the sources from which it derives its funding. Now, let us see the example why company borrows. As I said, liabilities are the borrowings made by the company or it's a loans raised by the company from it has borrowed from external parties. So, what are the benefits? In case, for example, if you take the short-term loans, businesses often take short-term loans. So, they borrow short-term loans. Why? Why do they borrow loans? Because to cover the operational expenses of the company or to take some advantage of opportunities that they are getting in. And these liabilities help the companies to ensure that they can meet their day-to-day financial obligation and maintain the liquidity position. So liabilities are nothing but that provide the businesses with the sources of capital that can be used to finance operations, growth, investments, without immediately using their own cash or without diluting their own capital or without diluting their own ownership. These liabilities, that is the borrowed amount, would be helpful and acts as a source of capital for the business to manage the day-to-day activities and to finance some operations, and even it also helps in making investments. So liabilities plays a vital role for the company's growth. Next, the third component in the equation or a third element is capital. So capital is basically referred as owned funds or equity. In accounting and finance, because it represents the ownership stake or interest that the owners or the shareholders have in a business. So in simple words, it is the capital contributed by the owners. So capital represents the fund that the owners have contributed by themselves or invested in the company. These owners may be comprising of individual or a partners or shareholders. So that is why it is called as owned funds. We call it as owned funds because it is the owners are contributing. The owners may be individual partners or shareholders, and because it reflects the ownership interest in the company. And basically in the balance sheet terminology, on a company's balance sheet, the capital and the term equity are used interchangeability to represent the same thing. And it is only the balance sheet that provides a snapshot of the company's financial position. And the balance sheet shows that the accounting equation is being correctly followed. And why capital is important for the business? An example. In case the business wants to go for an startup or an expansion, again capital is essential for starting a new business or expanding an existing one. It provides the initial funds needed for purchasing assets, securing a location, and covering the startup cost. So for all these, the initial investment is needed, that is nothing but the capital. Even for purchasing assets, capital allows a business to acquire necessary assets such as machinery, equipment, vehicles, property. So these assets are crucial for the production and the delivery of the goods and services. So these are some pictorial representation of assets. And so this is the accounting equation. Assets is equal to liabilities plus capital. And remember, the total value of a company's assets should always equal the sum of its liabilities and capital. This equation must hold true at all times, ensuring that the company's books are balanced. Thank you.